Budget 2025. What's been good? What's been bad? What's been downright ugly? Welcome to the 9th episode of the Ask About Wealth podcast. Earlier this week, Minister Jack Chambers stood on the floor of the Dáil and delivered Budget 2025. It's been the talk of the town ever since. We want to add our piece to this conversation. And bear in mind that when we do, we're talking about Ireland's high income earners. Before Budget 2025, we have been told by Revenue that those of you who are high income earners, which Revenue define as having 102,000 a year income or more, not just as an individual, by the way, the Revenue refer to you as units. So if your unit, you and your spouse, have 102,000 euro a year or more, you're considered high earners by the authorities. Prior to this week's budget, you guys have been paying 55% of the total income tax collected by the state. Will this week's budget change that? I'm afraid it won't. What did it change? We've read about in the headlines the expansion of tax bands, the reduction of USC charges, etc., etc. But what does that really mean to you if you're a high income earner? We've run our numbers here. If you're earning 100,000 a year as a unit in Ireland, then the tax you'll pay in 2025 is about 3.5% less than the tax you would have paid the previous year. If you're earning 200,000 a year, it's about 1.22%, less than you would have paid last year. If you're earning 300,000, it's a mere 0.68% less. This budget has been aimed at the middle Ireland in terms of income, those earning between 40 and 70,000 a year. And again, running our numbers, we see that they'll pay roughly 7% a year less tax than they did prior to Budget 2025. So for you, the high earner, who's getting considerably less tax relief, if you like, than the middle earners, not only will you continue to pay 55% of the tax take, you're going to actually pay more. What this means for high income earners 2025 onwards is that it is even more imperative than it has been that you exercise your right to pay as little tax as legitimately possible. And here in this podcast, we'll look at some of the ways you can do that. For those of you very familiar with Ask About Wealth podcasts and other means of communication, you know we're big fans here of the retirement funding legislation. And there have been some changes made to this legislation in recent times, coinciding with the budget, but not by the budget itself. The biggest change to report to you is that the cap on retirement funds in Ireland, which currently stands at €2 million as a maximum, will be increased over the next few years to €2.8 million. That will start in 2026 at 200,000 and will each 2026, 27, 28 and 29. So by the end of 2029, what is called the standard fund threshold will be increased to 2.8 million. And that has to be welcomed because there hasn't been an increase in that for the last 10 years. So inflation has eroded the real value of that over that time. And it's worth pointing out that prior to that 2 million cap being implemented in 2014, the caps were substantially higher. I remember when caps were 5 million plus. It's important that we go back towards that type of allowances because, frankly, even though I'm not saying 2 million is an insignificant amount of money, but it is an insignificant amount of money if you're on 300,000 or 400,000 a year. Think of it this way, 400,000 a year, if you try to replace that with a pension, you'd need far more capital than 2 million or indeed even than 2.8 million. This being said, if accumulating wealth for your future is your aim, there is no doubt retirement funds remain the sharpest tool in the box to achieve that result. They allow you to invest tax-free, so comparing that to personal investment, you get, broadly speaking, 50% more in at the start. They allow you to do that if you're a company owner with company money. So you get to transfer the beneficial ownership from the company to yourself in a zero tax environment. They allow you to invest that money and pay no income tax on the income your investments generate and no capital gains tax. Think of it this way. If you had €100,000 to invest and you take that as salary, you get to invest €50,000 after tax and levies. Now, the investment return you get is broadly speaking halved by ongoing tax. So your €50,000, let's say it gets 5% a year, you actually keep 2.5% a year. Compare this to putting the same 100,000 into a retirement fund. The first thing is that the 100,000 gets in. Your capital being invested is, in this example, 100% more. Not only is it 100% more, but the returns you get on that capital are also tax exempt. So if you get 5% a year, you get to keep 5% a year. The retirement vehicle is simply a tool that allows you to invest more of the money you earn and keep more of the investment return, thus getting you to whatever your financial objectives are that much quicker. I've often said to people during my consults, if I explained this in the Middle Ages, I might have been burnt at the stake as a witch, because you seem to be making money out of thin air. The same money invested in the same asset, producing the same return. Inside a retirement vehicle, you simply double the wealth when compared to doing it in a personal environment. So while pension funds need further enhancement, while we would encourage the state to go back to the caps that existed pre-2014, which, if we remember, were introduced to try and save a state that was floundering from a financial point of view on the back of the then credit crunch crisis, global financial crisis. Today's state isn't floundering. Today's state is having billions and billions in surpluses. And again, we encourage the state to go back to pre-credit crunch caps. But until they do, we encourage you, as Ireland's high income earners, to use as much of these allowances as you possibly can, pay as little tax as you possibly can, and build as much wealth for your future as you possibly can. How much use can you make of this legislation? We've reported before that in January 2023, the state lifted the cap on contributions that can be made by your employer. We did expect this budget to review that legislation and change that to some sort of cap, but we haven't seen it yet. But of course, the budget is but the start of the budgetary process. The end of that process is the Finance Act. So we'll need to wait for the Finance Act, which will be published in January next, to know whether that massive allowance still exists. So what happened with inheritance tax this week? You've heard me say it before. We certainly are of the opinion that inheritance tax is the least fair tax being levied on Irish people today, because the assets on which it is levied have been accumulated by one generation, paying a huge amount of taxes as they are accumulated, and then another huge amount of tax is levied as those assets transfer from one generation to the next. While it is to be welcomed and to be noted that the tax-free threshold, for example, between parents and children have increased this week to 400,000 from 335,000, what should also be noted is that the current tax rates and the current thresholds were calculated when we were in a major economic crisis. In 2008, for example, if you had inherited €1 million property from mum and dad, you would have had a tax-free allowance or tax-free threshold of €521,000, and you would have paid 20% inheritance tax on the balance. That would be a tax liability just short of €100,000. If you inherit £1 million property today, even taking the recent increases in thresholds into account, your tax liability is over €100,000 more than it would have been in 2008. And that doesn't take into account the increase in the property value. If you look at the increase in the property value, which the CSO tells us across Ireland was about 135% last year of what it had been in 2008, then the tax you pay on that same property rises to over €300,000. This is the least fair tax on the Irish statute books. We again encourage the state to remove the rates and bans that were introduced during a global economic crisis, where Ireland was posting massive deficits in its public finances. We're now posting massive surpluses, and yet the tax rates remain the same. The bans remain the same. So we encourage the state to make these changes, and we encourage you, until the state does make those changes, to look into every legitimate way that the inheritance tax can be avoided. There are many legitimate ways that it can be avoided. All you need is an advisor at your side who knows those ways and can help you apply them to your and mum and dad's situation. Well, so far we've talked about various reductions. The budget also included various increases. And in particular, I want to bring to your attention stamp duty on property, because the changes made were a big surprise to most people. They hadn't been predicted in advance. And they are certainly aimed at you, Ireland's high earners, because they are levied on properties of a substantial value. Take, for example, today, a property of €2 million. If you were buying that home prior to this budget, you would have paid €30,000 in stamp duty on the acquisition. Now you'll pay €50,000 on the same acquisition in stamp duty. The budget for high earners is a bit of swings and roundabouts. What you gain in the swings through a slight increase in tax credits, through a slight reduction in the USC lower band, through a slight reduction in the tax band, or an increase, I beg your pardon, in the tax bands. You're going to lose in the roundabouts. You're going to lose it in carbon tax by putting petrol in your car or buying oil for your heating. You're going to lose it in stamp duty when you trade in one home and buy another one. You're going to lose more than you gain. This budget certainly wasn't for Ireland's high earners. As I've said before, if you're one of those earners, it is imperative that you take every action possible to reduce your tax liabilities where you can. So far, you may think I'm being quite critical of the budget, and perhaps I am, but there have been some very welcome initiatives in this budget too. You've heard me talk about EIS schemes, Employment Investment Incentive Schemes, before. And in this budget, the government seemed keen to encourage high-income earners to invest in various startups and early start Irish businesses. The EIS scheme has expanded its maximum allowance, which prior to the budget was €500,000 to be written off against tax, to €1 million. That applies to EIS companies that are offering a 7-year plus investment term. Those offering a 4-year plus investment term, the allowances remain the same, €250,000. But what this does mean is that for those of you with high income, for those of you with the wherewithal, that you could invest up to €1 million and get all of the tax back on that €1 million paid historically. At the current rate, that's a €400,000 tax rebate. Let me say, EIS is not for everybody. EIS by its nature is high risk. Also this week, we hear about the potential for capital gains tax relief for what the budget has referred to as angel investors. Venture capitalists, if you like, who are willing to invest in startup businesses. We don't have any details yet, but it seems likely that the capital gains tax rate on these will be roughly half what it would normally be if you are investing in a qualifying entity. So watch this space. We're waiting for the Finance Act to see details on this. We will bring those details to you as soon as they become available. So, have I touched on every tax break or tax concession announced or expanded in this week's budget? No, I haven't. Things like electric vehicles relief, which can massively reduce the tax you pay on a company car. Things like the small benefit exemption, which can give you a tax-free Christmas. Things like subsistence allowances, capital gains tax allowances when you're selling a business. These are all legitimate tax concessions that are available, but we don't have time to go into them today. We will do short videos in the future on these issues. Please stay in touch. Please keep an eye on Ask About Wealth across all our platforms, and further information will follow shortly. The American founding father Benjamin Franklin famously said, "There's nothing sure in life except death and taxes." While here at Ask About Wealth we can't do anything about the death, not yet anyway, what we can do is point you in the direction of legitimate tax concessions. You may have heard me say it before, but there's a bad joke in our business about what's the difference between tax evasion and tax avoidance. And the answer is 6 feet, the width of a prison wall. Evasion is illegal, breaking the law of the land. Avoidance, which is what we can help you look into, is using the law of the land to pay only the taxes you must pay. After this week's budget, that is more important than it has ever been before for high income earners here in Ireland.